And we're live. Good evening, good evening, good evening. And welcome to another Life After Hours with Life Sherpa. I'm Vince Scully, and you're on Life After Hours. Before I get started, I would just like to acknowledge the Camaragal people, the earliest recorded inhabitants of the lands that today we call North Sydney. And we are joined by many people around the country. So we'll just pause for a moment to get people time to sit down and relax and join us. We don't want to indulge people who are running too late, but a couple of minutes is always a good length of time to get started. After all, this is all about you. Life After Hours is the time that you get to ask me and the Sherpa team all those burning questions that you haven't had a chance to answer otherwise. So welcome. So just firing up the slides, and I guess it is time to get a wriggle on. We don't want to give people too many excuses for turning late. So tonight, because it's July and June 30 is still not that far in the rearview mirror, tonight we're going to focus on getting your tax return done, and in particular, dealing with your shares and ETFs using the online MyGov facility so that you can do your own tax return. And then we look at a few other important pieces about doing your tax return as well. So, but very much a focus on shares and investments. And so getting started then, we always like to put a bit of context to what we're talking about, and we always do that in the context of the Life Sherpa 8 Steps to Financial Freedom. And as you all probably know by now, in fact, we got some newcomers on the line tonight. So just very briefly, 8 Steps to Financial Freedom. This is the methodology that we use as the foundation for all of our education, coaching, and advice here at Life Sherpa. And so we have the 3 foundation steps. That is step 1, spend less than you earn. Step 2, build an emergency stash. And step 3, pay off your debts. That is the foundation for any of your other financial goals. We then move on to the 3 protective steps. Step 4, prepare for the unexpected, largely about getting your insurance package right. Step 5, get your super right. And step 6, sort your paperwork out. And then step 7, the 2 growth steps. Step 7, buy and pay off your home. And step 8, invest your surplus. So tonight we are, of course, focused on paying your taxes, which is step 6, sort out your paperwork. And that's the context for where we are tonight. Now, just before I run through what we are going to cover, there is a little bit of detail in tonight's slides, and they are available for download right now in the chat or in the files section. There's a PDF file that you can download. So if you're doing this on your phone, you might want to do that now. So tonight we're going to focus very much on the MyGov approach to DIY tax return, and getting started in configuring MyGov for the type of income and deductions that you're going to be lodging. Then we'll focus on the general income piece, and then move on and look at dividends and contrast those with trust distributions. Then we'll touch briefly on rental income and deductions, and then come back and look at general deductions. And so we'll cover off any questions you might have on any of those. So moving right along, you can access the online tax return through the MyGov. That's my.gov.au. And you will need to set up an account, and you'll probably set up two-factor authentication. When you set up your account, you can link your various government accounts with it. For most people, that is the ATO for their taxes and HEX, Centrelink, and of course, Medicare. Those of you with kids have probably spent a lot of time dealing with the Centrelink connection, and it works quite well. So this is a facility that's improved no end. And over the years, the amount of this information that gets pre-filled is getting better and better. Sometimes some of this pre-fill doesn't happen for a while. We're certainly seeing that the health fund lodgements are coming through now. Some of the insurance companies have already issued their statements of deductibility. Most banks and employers have put theirs through. You may find that some managed funds, which includes ETFs, and I'll come back to that later, might not get there till August or so. So sometimes it's best not to rush into these things, but if all you've got is interest and salary income, you've got a health fund, and you might have some insurance, that should all be there by now. Excuse me. And just keep an eye on it and see when your managed fund stuff populates. So the first step in doing your tax return is to start personalizing it. And this is the bit where you tell the ATO what type of income you're returning. You will find some of these sections blurred just to preserve the anonymity of the person whose account this is. So the first step is, for most people, you're going to have some salaries and wages. You may have some government payments and other types of income. So this is where you tell it. Few people here will have income from superannuation or annuity funds, so we can skip that. These are the bits where we're really going to focus tonight. So that's interest and income from investments of property, managed fund and trust distributions, and we'll touch briefly on work-related tax expenses later on. And that's the main one here. That will then bring up the relevant sections further down in your return. But before we get on to that, just a couple of things. The ATO is getting more and more sophisticated in where it sources information from. So hiding stuff from the sharing economy or cashies is becoming harder and harder to do. So we do operate on a self-assessment system, which broadly means that as a general rule, the tax office will take your word for it, but reserves the right to ask you to justify it in the future. So usually, just about anything will get put through, will go through on a first blush, but they obviously reserve the right to come back. There are a number of checks in here where they look at your deductions relative to your income and see if that makes sense based on the job that you do. But sharing economy, so if you're doing jobs in Airtasker, you're renting your property out on Airbnb, you're riding Uber or Uber Eats or whatever, the tax office knows. So don't try and hide that. So looking at the income side, so your salaries and wages are now reported electronically. They're generally reported every time you get paid. So there's a system called single touch payroll, where when employers make a payment and withhold the tax, that goes electronically to the tax office. So during the year, you can generally keep a close track on what you've been paid year to date. And when it's finalized for the year, you'll find a little label that says tax ready. And so this is pretty reliable. I've yet to see an error in this, but it is always worth, just double checking it back to your last pay slip for the year, which will show your year to date numbers. But these are now getting pretty reliable. And the same with interest deductions. The banks should all have reported those by now. So if you've given the bank your tax file number, it will turn up here. Dividends, again, they will generally be pre-filled and reported, but you do need to double check. And then, of course, manage funds and trust distributions. We'll come back and look at what they look like in detail in a moment. But an important point here is dividends are recorded when you actually receive the cash, or more technically, the ex-dividend date. So if many of our big companies pay dividends in the first couple of weeks of the financial year, so although they are generally paid out of profits the company made in the previous tax year, because they paid it to you in July, you will record it in your next year's tax return. So the timing of a dividend is pretty critical here. That's in contrast to managed funds, and an ETF is a form of managed fund. They are broadly trusts, and trusts distribute their income to people in the tax year. So you might receive a cash payment in July, but it's in respect of the year just ended. So you'll find that on the distribution notice. But generally, if you're getting an ETF distribution now, that will be a distribution of FY24. That is the year ended June 30, 2024, trust income. So a trust, in order to make sure that it doesn't pay tax itself and it can pass it on to you, it's got to make all of its unit holders entitled to some income at June 30, and it will often not pay that cash for a while. So from funds that pay quarterly or semi-annual, you'll receive so for the quarterly ones, you'll receive a payment in usually for September, December, and March, and then you'll receive the June 30 number in July. So just check your statement as to which year it relates to. But that's a big difference between shares which pay dividends, and they're accounted for in the year you receive them. Trusts and managed funds and ETFs are trusts, and there you have to pay tax on the income in the year the trust earned the income. So a bit of a trap for young players there. Then, of course, the next step is rent, and we'll come back to that when we look at rental deductions later on. And capital gains are probably the harder one to track, because the tax office generally, it knows you've had a CGT because it's seen that you've sold some shares, so it knows that the transactions happened, but it's not able to work out what your capital gain is. And that can often be a time-consuming and complex thing to track, because you need to track each individual parcel of shares or units in an ETF or managed fund that you buy. And so if you're participating in the dividend reinvestment plan and putting in money every month or every quarter, you will find that you'll end up with quite a lot of individual parcels. And so when you sell some to rebalance your portfolio, you've got to work out, well, what parcel did I sell and what was its cost base? This is a great reason. Another great reason is if you really needed one, to not participate in dividend reinvestment plans. I would generally encourage you not to sign up for a dividend reinvestment plan, but it does happen when you get when you're doing regular contributions, and if you're invested in particularly property trusts, which often distribute some capital, so your cost base can go down or indeed up. So tracking that's difficult. So that's where a good platform or a piece of software like ShareSite or Navexa will help you keep track of that. Doing it on a spreadsheet is possible, but time-consuming and error-prone. And so if you are dripping money in and participating in the DRP, don't try this on a spreadsheet. So moving ahead then to the distinction between shares and trusts. So I did just note that shares pay dividends, mostly franked, at least Australian shares will pay mostly franked dividends. And franked means it includes a franking credit, and franking comes from the old way of putting a stamp on so when you put a stamp on a letter, it was then franked to indicate that it had been used. So franking often applied to the application of a stamp or payment of a coupon. So in relation to shares, when a company earns a profit, it pays tax on that profit. And so when it pays a dividend out of that profit to its shareholders, it attaches to it a tax credit or franking credit, which makes dividends quite tax effective. So if you think about a company that makes $142, I think is the maths, profit and pays 30% tax on it, leaving it with $100, it will then pay you potentially $100 dividend and attach the $42 of tax that it's already paid on that to you. So you're now, from a tax perspective, received $142, even though you only got $100 in cash. And that $42 is then a credit against the tax due. So if your tax rate is 30%, there will be no further tax payable. If your tax rate is lower than 30, for example, a super fund, you will get a refund for the extra tax paid. So that's shares. Trusts, on the other hand, distribute their profit without paying tax on it. And so the thing that they hand out is called a distribution rather than a dividend. And it may still include some franking. So a trust, for example, IOZ, the BlackRock Australian ASX 200 ETF, holds broadly 200. I think it was 197 at the last test, but it holds broadly 200 of the largest companies in Australia, most of whom pay franked dividends. So the income of IOZ is the dividend plus the franking credit, which they then pay on to you, and you are entitled to that franking credit as well. So you will find that in your distribution or your AMIT statement, Australian Managed Investment Trust, I think it stands for. And we'll see how you apply that shortly. So looking at dividends, first of all, there are a few rows here. So the first row is your the ability to write some notes, and then you include the amount of the dividend and the franking on separate rows. There's also some space here, I think, for no. So here's where you add in most companies will they'll either pay a fully franked dividend, where you just put the whole amount in the franked column and then the franking credit in the franking sheet. Where companies pay partially franked, where they don't have enough franking credits to cover the whole of the dividend, you'll find you'll get an unfranked component. In most cases, you'll find this is pre-filled, but you should double check it against your distribution or your dividend statement. They are pretty reliable. So that's reasonably straightforward. So you've got total unfranked amount, total franked amount, the amount of the credit, and where you hadn't provided your tax file number, there will be a tax file amount withheld. So if you haven't got a tax file number, that company is obliged to withhold some money. So generally you want to be giving your tax file number to the companies you've invested in. Usually you're going to do this through the registry, so it's usually Computershare or Link, but that can become a bit tiresome. So again, another great reason to use a platform. But moving on now to the trust distributions, and this is a little bit more complicated because we need to report all the different components of the distribution. So I said you may get franked distributions where that's a distribution of franked dividends that the company's received. There may also be capital gains where the fund sold some shares and made a capital gain. And then there are a whole bunch of other components. I think there's 20 or 30 potential components. You probably won't see all of them. But when you get your ARMIT statement from your ETF or managed fund, it will include a list of all of these things. And it usually refers it to the label. So depending on how big a screen you're watching on this, if you look at the fourth row down, it says 13J, total non-primary production income. Now, that's where much of your trust distributions are going to appear, but you will find that little number 13J used on your ARMIT statement. So when you get your statement from Vanguard or from BlackRock or from whoever is issuing the fund, you'll usually find that the description lines up with the description here and the number is the key thing. But again, you will find usually that this is pretty well pre-filled. But go through your ARMIT statement and look out for those little numbers, so 13J, 13C, 13Y, and it's painting by numbers. Just copy the number to the label it describes. Some of these are a bit obscure, but if you just follow the numbers, it will all work. And in most cases, these will be pre-filled. So that's really, just be very clear about the differences between trusts and companies, and you'll be pretty well right. If you hold foreign companies, you may find this is not pre-filled, and there you may have to deal with some foreign tax credits. That's a little bit more complicated. So those of you who hold James Hardie and a few other companies, that's a little trap for young players. So moving on to rental income, this is where things start getting a bit more complicated. In particular, deductions for building allowance and depreciation, and where you do maintenance. So if you haven't done any of those, then it should be reasonably straightforward. You will get most of the information you need from your real estate agent's statement. I assume you are using a real estate agent to manage your tenant. They will give you a statement. And it's important to know that it's the date the income was received by your estate agent. So when did the tenant pay the rent is what's relevant here. So all of the usual deductions are pretty clear, body corporate, water, rates, interest, they're all pretty straightforward. Where it starts getting a bit more complicated is what's called building allowance and depreciation. And they're both broadly accounting speak for stuff wearing out. So Traditionally, depreciation applies to movable items or plant and equipment. So in your house, it's going to, or in your rental property, it's going to be things like carpets, curtains, hot water service, all those things that sort of wear out over time. Now, traditionally, accountants would not have depreciated the building itself on the theory that it lasts forever. But the government brought in this thing called building allowance, whereby the fabric of the building itself, you get a deduction for that. And that's called building allowance. It was originally brought in as an incentive to invest in property, and it's been through a few iterations at the rate. But broadly, it's written off over 40 years. So you get 2.5% of the value of the building itself. The bricks, the foundations, the landscaping, the wiring, the piping, all that stuff that is pretty well fixed to the property, and you get 2.5% of that a year. Depreciation, on the other hand, is based on the life of the individual asset. So the tax office has gone through and painstakingly developed approved lives for all of these things. So there is a publication you can download off the ATO which give you those numbers. So in practice, the best way to do this is to get a depreciation schedule from a quantity surveyor who will go through the building and go, well, look, it's got 55 square meters of pine flooring, which is worth X, and they will develop a schedule and apply all of the effective lives to that. So that will be a few $100 very well spent. I've always used a BMT for mine, but there are a large number of providers. You're just looking for someone who's a licensed quantity surveyor to do that. And you generally do that once when you buy the property or start renting it out for the first time. And then you need to track your actual spending on stuff that's not repairs and maintenance. So the next step then is repairs and maintenance. So when you spend some money to repair something, that is either going to be deductible in the year that you spend it. So if the hot water service breaks down and you send someone out to fix it and replace the elements, say, well, that's a repair tax deductible in the year you incurred. If, on the other hand, you have to replace the hot water service because its life expired, then you don't get to deduct that all in one go. So when that activity happens, you would write off whatever's left of the old one and add in the cost of the new one into your list of plant and equipment and start depreciating that over its effective life. And the effective life varies by the type of installation it is. So that's where these things start getting a bit complicated, and you might want to consider an accountant. But getting your depreciation schedule is the key thing at the beginning, and then tracking the spending and working out how much of that is immediately deductible and how much of it is got to be capitalized and written over its life. This is where good professional advice will help. And then finally, just looking at general deductions. The ATO has a set of publications for most occupations as to what they think is a reasonable thing for you to deduct. But broadly, the key thing is you have to have actually spent the money, and it has to be somehow related to earning your income. So if you work outdoors, sunglasses, sunscreen. If you're a doctor and you've got to subscribe to some medical journals, then that's clearly deductible. So all of those things are included at this point. The other things that will usually fit in here is income protection insurance. So the premium on your income protection insurance, which is probably the most important part of your step 4, preparing for the unexpected, to the extent that it's not paid for from your super fund, it will be deductible, and you will get a statement from your insurance company saying, here's how much of it is tax deductible. Usually 90-something% of it is tax deductible. So work-related expenses, and the big one for most people is going to be working from home. I think most people are still doing some hours from home. The incentive has been reduced post-COVID, so it's now 67 cents per hour is the flat rate, or you can claim the actual ones. Now, we covered this in a little bit more detail in the preparing for year-end life after hours, so you might want to go back and re-watch that. Obviously, interest expenses, and they're the real estate, vehicle expenses are the other big ones. But you've got to be able to substantiate the fact that you spent the money, so it's a receipt. For small amounts, you can rely on your credit card statements, but generally a receipt's better. I generally take a photograph of the receipt whenever I buy something, and then upload that to Xero for when I'm keeping track of all of these things. But you can use any app you want. The ATO has their own app. So they're the main deductions here. But key thing is you have to actually spend it. So if your employer reimburses it, not deductible. And it needs to be directly related to earning income. One of the ones that's quite confusing is financial advice expenses. Stuff that's related to managing existing portfolio, tax deductible. And usually that can be paid for, is usually deducted from your investment account. An initial plan or help with budgeting, surprisingly, is not tax deductible. So talk to your accountant or advisor around those ones. Okay. And that's sort of the end of the presentation piece of these. As always, this is the Bible. This is the core of what we do at Life Sherpa. The 8 steps are set out in some detail here with some exercises that you can do. So this is the money handbook that we work through at Life Sherpa, and here's a little code to get you a little discount, get you $25, shipping included. Which then brings us on to question and answers.